There's still time to contribute up to $66,000 plus in a Roth. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of Adam Talks. On today's podcast, I'm going to explain to you how, yes, you can actually still, up till October 15, 2023, make a contribution of $66,000 plus in a Roth account. How is that possible? 66,000 plus. Yeah, in fact, up to 73,500. Yes, 73,500 if you are over the age of 50 years old. So how does this work? Well, it's called the Mega Backdoor Roth 401k. And I've spoken and blogged about it and done a bunch of videos on it over the last number of years. And really since 2014, it's become a super, I would say, kind of secret Roth maximization solution that only a few savvy people know about it. So here it is for all of you to finally digest it. So it really applies if you have a solo 401k. Why? I'll explain in a minute, but if you work at Apple, Tesla, or even IRA Financial, there may be restrictions on your ability to do a Mega Backdoor Roth because of certain requirements from ERISA rules in terms of top-heavy testing and something called ADP and ACP testing, which is deferral percentage and contribution percentage. Meaning if too many of the high earners, the executives, are doing these mega backdoors and not enough of the rank and file employees, then it's going to fail a bunch of ERISA tests and the IRS won't allow it to happen in the plan. So that's why if you have a solo 401k, you don't have to deal with any ERISA testing because you're the only participants, you or a spouse or other business owners. There are no non-owner employees you got to worry about. So the podcast is going to talk about the Mega Backdoor Roth. Even if you don't have a solo 401k plan set up now for the 22 years. So even if you have one now, but you didn't set one up in 22, all good. You can still do the Mega Backdoor Roth 401k so long as you set up your solo K before October 15, 23 for the 22 taxable year. Now, this podcast, I'm on the assumption you have not filed your tax return yet for 22. If you have, well, it could be problematic unless you go amended, assuming your plan has already been set up. But it's actually not a tax deductible contribution. It's an after-tax contribution. But technically, you should not make this contribution. You should only make the contribution if you have not filed your 22 tax return yet. You can file an extension, but you cannot have filed the final return. So what's a Mega Backdoor Roth? Well, it's kind of like the Backdoor Roth IRA, except it's even less restrictive. So with a Backdoor Roth IRA, if you make more than $228,000 married, filed jointly, $153,000 single, you can't do a Roth IRA. There's income limitations. But you can do what's called a Backdoor Roth IRA, which allows you to make a after-tax IRA contribution and then immediately convert it to Roth. And since you are going after tax to Roth, there should not be any taxation on that conversion. Because generally, when you do a conversion of pre-tax funds to Roth, you pay tax on the amount you convert, whether it's cash, whether it's a piece of real estate, stocks. You pay tax on the fair market value of the asset or cash you're converting, and you pay the tax on your tax return, and it's included with all the other income you have for that year, and that will determine what tax rate you pay. And it's generally ordinary income. Okay, so if you convert $100,000 of cash and you made $100,000 as a lawyer, you pay tax on $200,000 bucks. So the one caveat with a backdoor Roth IRA is that if you have other pre-tax IRAs out there from prior years, whether it's a rollover from a former employer, or you just kind of set up a IRA back in the day, pre-tax IRA, and now you want to do a backdoor Roth IRA, which is limited to $6,500 or $7,500 if you're over 50 for the IRA world, there is a pro rata formula that will determine how much of the current after-tax contribution can be converted to Roth by way of the backdoor. So for example, say you had a $5,000 IRA from prior years and it's worth $5,000 today. And now you want to do a $5,000 after-tax contribution in order to backdoor to Roth because you make more than 228,000 married file jointly, or you make more than 153,000 single filing. So the way these pro rata formulas work is that you take the 5 plus the 5 you had before, that's 10, and you want to backdoor 5 out of 10, that's 50%. So based off this formula, only 50% of the $5,000 after-tax contribution that you want to backdoor will go to Roth, and the rest would be taxable. Right? And that's a way to take into account all prior pre-tax IRA contributions. Solo K, the rules are very different. Number one, there's no pro rata formula. Okay, so you don't have to worry about all that. Number two, you can go up to 66,000. Well, in 23, 66,000 or 73.5. For the 22 taxable year, you can go up to 67.5 if you're over 50, and you can go up to 61 if you are under 50. So if we're talking 22 here, okay, the 22 contribution numbers are 61K if you're under 50, or 67.5 if you're over the age of 50. So the 66 and the 73.5 are for the 23 taxable year. But if you want to do contributions for the 22 taxable year, because you have until October 15th for 2022, the numbers are 61 and 67.5 if you're over 50. So as I mentioned, you can still go over the 66. You got to be over the age of 50. If you're under 50, you can do 61,000. That's pretty incredible. Dollar for dollar, $61,000 in Roth. And this is how it works. So number one, what's a Solo K? Solo K is a 401k retirement plan that essentially is adopted by a business, could be a sole proprietor, single member LC, corporation, C Corp, S Corp, partnership. The only rule is it can have no full-time employees other than the owners or their spouses. Full-time employee means 1,000 hours a year or 3 consecutive years of 500 hours or more. So if it's just me and my spouse and we own a bar and we have no full-time employees, no one works more than 1,000 hours, maybe it's just, part-time people, we can set up our own solo 401k. If I'm a law firm and I have 4 partners and we do all the work, we have no employees, no paralegals, we just love to do all the work ourselves, then because we have no non-owner employees, we can set up a Solo K. So bottom line, you don't have to be just a one-person business. It doesn't have to be your primary business, right? You can be a CEO of a company and on the side you do consulting. You can have a solo 401k for that consulting. Let's say you are you work at Apple, and on the side you sell shoes on eBay or sell art on Etsy or some other website. That's okay. Even if you generate a few $100 a year, technically you are in business. You don't need to be a $1 billion business. So that's important, because the solution doesn't just mean you have to be 100% self-employed. You can be a full-time lawyer, accountant, doctor, real estate developer, agent, just software developer, whatever. You can do anything you want, but if you have a side gig, even if it just generates a couple $100 a year, that side gig can set up a Solo K, and then you could roll funds into it, or obviously contribute some of those funds by way of this Mega Backdoor. So when you make contributions to a Solo K, there's basically 3 buckets. The first bucket is the employee deferral, right? The second bucket is the profit sharing, which is 20% of your net schedule C if you're a sole proprietor or single member LC, or 25% if you're a W-2. And then the third bucket is this Mega Backdoor. The employee deferral, generally, if you are a sole proprietor or single member LC, you have until October 15th, including extension, to make that contribution if your plan's been set up in 22. If your plan has not been set up in 22, all you're going to be able to do is the profit sharing or the Mega Backdoor. The profit sharing is 20% of your Schedule C or 25% of your W-2 if you're a C or S Corp. And the Mega Backdoor for 22 will let you go dollar for dollar up to 61,000 or 67,500. So it's not a profit sharing contribution, it's a dollar for dollar. Now, the only caveat to keep in mind is you can't go above the 61 or the 67.5, right? So if you already put 15K into your 401k, when you're under 50, you're going to be able to do another 46,000 in Mega Backdoor. If you did 5,000 or 6,000 or 6,500 in a Roth IRA, it has no consequence on this contribution. So you can technically do 6,500 or 7,500 into a Roth IRA for 23, or if you make contributions in 22, and you can do the 61 or 67.5 in the solo K as a mega backdoor. The important requirement to remember is that you need to have enough income, right? So if you sell shoes on eBay, Nike Dunks or whatever, my kids like Nike Dunks, they collect these shoes, and all you make is 20K, then obviously you can't contribute 61, right? You can't contribute more than you make. But if you were to do consulting and you made 80, and you also earn 300 as a lawyer or a doctor or software developer, you already maxed out on another plan, okay, you can't do more than the employee deferral. So let's say you put 20,000 bucks in the employee deferral. You can then do 41,000 if you're under 50 in the mega backdoor, assuming you had enough money through your solo K. Okay, so the employee deferral cuts into the the 61 or 67.5 along with the profit sharing, and then whatever's left you can do mega backdoor. If you haven't done any contributions into a solo K or to a regular 401k plan, then you can go all the way up to 61 or 67.5 at Roth. So if you take anything away from this podcast, remember, even if you don't have plan set up yet for 22, you can still set it up prior to 2023, October 15th. You need to have a side business. It doesn't need to be Google or Tesla. You can just generate 20 grand, 15K, 10K, 30K, whatever it is. You can't contribute more than you earn on that business. But if you have a situation where, whether it's your primary business or just a side gig, and you have some extra money and you don't need it and you'd rather put in Roth, why would you want to go Roth? Especially because you don't get a tax deduction for going Roth. Well, the main advantage of going Roth is that once you're over 59 and a half and the Roth's been open at least 5 years, everything is tax-free. So all the Roth distributions are tax-free. So the way this mega backdoor Roth works is, let's say you made 80 grand and you want to put it all into a mega backdoor for 22. You haven't set up your plan yet. So you call IRA Financial, or you go on our app, you 5 minutes, you have a plan set up, and essentially you work with us. We will provide you obviously a team of people to work with. We'll set up a solo 401k bank account at Capital One or wherever else you'd like to bank. And we would explain to you that 401k after tax contribution we made to one bank account under the plan. We'd have a second bank account for the Roth. You would literally just wire the money from the after tax account to the Roth. We would 1099R it, show a 0 for the Roth converted amount. And then you can keep it in that Roth 401k account, or you can even move it to a Roth IRA. Yeah, it's pretty cool because generally in a 401k, if you're under the age of 59 and a half, you don't have a triggering event rule and you can't move money out of a 401k. But the way this mega backdoor rule works based off notice 2014-54, you actually could keep the money in the Roth component of the 401k or move it to the Roth IRA. Maybe you feel like there's better investment opportunities, or maybe you'll keep it in the Roth 401k because you want to take advantage of the exception to leverage under the unrelated business taxable income rules. So it's a lot of cool options. The beauty of this mega backdoor, why it's called mega, is a Roth IRA backdoor will only let you do 6,500 or 7,500. The mega backdoor for 22 will let you do 61, 67.5 if you're over 50, dollar for dollar. If you, for 23, let's say you're already finished with 22, but I'm getting you excited to do mega backdoors going forward, you can do 66,000 if you're under 50 or 73.5 if you're over 50 for 2023. So the bottom line of this podcast is, hopefully you're listening or watching this prior to October 15th. You haven't filed your return. You can easily set up a plan right now in minutes and get the process started. You won't get deductions, but what you can do is boost big time your Roth assets, your Roth contributions. Again, the Roth IRA only lets you go 65 or 7,500. This will let you go dollar for dollar up to 61 or 67.5. If you want deductions and you don't have the plan set up, you can still do profit sharing, which is 20% of your net Schedule C if you're a sole proprietor or single member LLC, or 25% of your W-2 up to the 61 or 67.5. So there are some potential deductions available if you want to go that way. But if you're like me and just want to Roth everything out, I'm a major Rother. I do all my contributions to Roth. I wish I could do the mega backdoor. I can't do it because our plan, we have 80 something employees, and unfortunately not enough of our team members want to do the mega backdoor. So if I was the only one that wanted to do it, I would tip the top heavy and fail that test, and it would not be allowed. but the business you work in, ask. I just spoke to a client a couple of weeks ago who actually was telling me that his plan, he works at a Fortune 500 company, and they allow for mega backdoors. They claim it would pass ERISA because they have enough people that want to do it. So definitely ask. It's an unbelievable Roth solution if you're a Rother like me and feel that pretty savvy investor, and will look forward to reaping the rewards of tax-free income and growth over our lifetime. The ability to put away, 30, 40, 50, 60,000 plus in a Roth each year is just unbelievable, right? Literally just extra money lying around. Instead of just investing it through a taxable account, just dump it in a Roth 401k and save it and invest through the Roth 401k. And this way, all the returns are tax-free. And you can borrow against it. And once you're over 59 and a half, you pull it out tax-free. So it's an unbelievable solution. I wish more people would know about it. That's why I do these podcasts and videos and I write a lot, is because I want to educate people. The retirement system is literally rigged in our favor. We just need to understand the rules and know how the game is played. Because trust me, there's a lot of smart, rich people that know how the game is played and take advantage of the power of the Roth. Other than life insurance, it's the best tax shelter out there. The advantage over life insurance is in your lifetime, you can use it tax-free, whereas life insurance obviously has a better death benefit than the Roth, but in both cases, the money comes out tax-free. The beauty of the Roth is once you're 59 and a half, the Roth's been open at least 5 years, you can literally live off the income tax-free. So you don't have to wait till you die for your family to enjoy it. You can use it today. Once you're over 59 and a half, Roth's been open at least 5 years. You can use it with your spouse, your kids, your church, your whatever, and do all the things you want to do with it tax-free. You don't have to wait till you die. So hopefully this got people excited. It's an unbelievable solution. I wish I was eligible to do the mega backdoor. I would go crazy and max out every year. And think about it. If you're able to put 50, 60K a year away in Roth in 10 years, that's 600,000 bucks. Imagine if you average an 8% rate of return, your money will double every 8 years. Like, you're going to have many, many millions of dollars tax-free when you retire. And it will be an unbelievable legacy you can leave to your family. You can also enjoy it during your lifetime if you want, and never pay a single dollar of tax on what you pull out. It's unbelievable, right? I mean, I know I get super excited. I'm a dorky tax lawyer, but I think you guys get excited too. Like, the ability to shelter all your income and gains. It's so simple and so easy. I mean, all should be doing it. Okay. So even if you can't do it, even if maybe someone in your family can do it, or maybe you have a side business. You're like, you know what, Adam? I do work full time. I'm a lawyer, an architect, accountant, doctor, executive, but I do stuff on the side. I consult, or my wife, my husband does stuff on the side. We can set up a plan through that. He or she can pay me, and I can just do this mega backdoor and just dump tons of money in the Roth. So we have an amazing team of tax professionals at IRA Financial. If you have questions about this, I know it kind of sounds a little bit confusing, but it's super easy to do. You set up the plan. We set up 2 bank accounts. You dump some money into the after-tax 401k. You then move it to the Roth. We code everything. We report it to the IRS as a tax-free conversion. And that's it. You're good to go. And any other filings with the IRS, we do for you. You don't have to worry about anything. So there you go. That's today's podcast. Yes, there's still time to put away 60,000 plus in a Roth for the 22 taxable year. Hope you guys enjoyed the podcast. Hopefully I sparked a little bit of excitement. If I didn't, I tried, I promise. It's a wrap for today. So have a great rest of your day. Enjoy the week. And I look forward to talking to everyone again next week. Take care.